So good afternoon, everyone. I hope you've all enjoyed our program so far. Before I call on the panelists to join me on stage, I just want to take this opportunity to really thank ACT-IAC for putting together this fantastic event. Ken Miller, Ken Allen, Carol Miller, Haley Sennard, Carly Fry, the entire team. Because without them, without their support, we would just not be able to have this sort of fantastic gathering. And the other thing I want to sort of emphasize is what a great organization that is. And if you guys aren't already a member, I really hope you guys consider joining, because I've had a phenomenal experience working with them, and I think events like these are just sort of what we all want, which is sort of industry and government working together to bring more efficiencies into sort of business, industry, and also government. So it is my pleasure now to welcome our third and final panel on stage. I'd like to ask them to join me here. You all can join us. Yes. In order to increase the openness of discussion for this panel, given that they're representing or they're with government and regulatory agencies, I'd like to just point this out that they're speaking on behalf of themselves and not so what they say is not attributable to their respective agencies, so that's sort of a ground floor. As with our other panels, we're really fortunate to have an expert group with us whose accolades and experiences are just too numerous and extensive for me to give a fair treatment of. So I'm going to give a very brief introduction for each of our distinguished panelists, and then we can dive into some of the policy and regulatory aspects of blockchain and emerging technologies that our expert panel will then address, and then share some of their thinking into how the policies and regulations could potentially respond to this rapidly evolving technology. We have Daniel Gorfine here in the center. He's the Chief Innovation Officer and Director for LabCFTC. Many of our TED Talk speakers, the opening keynotes, they had talked about LabCFTC and sort of awesome work that they're doing. This is the guy right here, Daniel Gorfine. I said Gorfine. He's with the U.S. Commodity Futures Trading Commission. LabCFTC is dedicated to facilitating market-enhancing fintech innovation, fair market competition, and proactive regulatory excellence and understanding of emerging technologies. We also have Valerie Szczepanik. Yes. She's the Assistant Director of the Securities and Exchange Commission's Division of Enforcement Cyber Unit. Valerie is also the head of the SEC's Distributed Ledger Technology Working Group and a member of its Fintech Working Group. And last but not least, we have Kelvin Chen. He helps the Federal Reserve Board understand fintech developments and navigate the issues they raise. Previously, Kelvin was program manager at the CFPB for emerging payments, where he led the Bureau's work on cryptocurrencies and other payment innovations. I'm going to now turn it over to Daniel to begin our conversation. I'm going to try to make this sort of just a informal conversation, really just making this talking about these issues can be a bit complex and complicated, and just sort of try to break this down and really just have a good conversation. I'll then perhaps ask a couple questions for each of our panelists, and then I will open it up to audience if you have any questions. We do have some time. So I'll turn it over to Daniel to start.
Great, thank you so much for those introductions. So I'm Daniel Gorfine, I'm Director of LabCFTC at the CFTC. Thanks for giving a good overview of what the initiative's all about, and I'm glad to join my co-panelists here. What I might do for the first few minutes is just give a little bit of a high-level overview of what LabCFTC is all about, and then I suspect we'll dive a little bit deeper into distributed ledger technologies and blockchain and how we think about those types of things. So LabCFTC was launched by the Commission last year, and it was really born out of some of the very proactive and forward-looking thinking coming from our chairman and our other commissioners in recognizing how quickly our financial markets are digitizing. and also recognizing that certain emerging technologies are having already and are likely to have even more so a direct impact on our financial markets and on financial services. So to be sure that we are proactive and not reacting to a very different looking world a few years from now, the Commission created LabCFTC to kind of be able to look around corners and see where the world's going. So we really boil our work down to three primary work streams. The first one is something that we call Guide Point. It's really the bread and butter of the initiative, and that's based on engaging and meeting with innovators. And that ranges from established financial institutions, startups, technology companies, anybody who's using technology to do interesting and innovative things in our markets, we want to meet with them. The value proposition is really twofold. For us internally, obviously it's an opportunity to learn and get a better feel for what is coming down the pike. On the flip side, for those who meet with us, we're able to provide high-level feedback and guidance as to how our rule sets may apply to certain activities. In other cases, folks may come in and say there are particular rules or regulations that are creating friction, or there may be some ambiguity, which is something that we as an agency would want to be aware of and potentially look at. The second prong of what we do is something we call CFTC 2.0, and this is the idea that as we learn about new technologies, there may be some that we want to support or facilitate, and others we would want to incorporate as an agency to become more efficient and effective at what we do. I'll give a quick example. One of the ways we can at least stimulate activity is under something called the Science Prize Competition Act, which allows agencies to host innovation competitions. So we're soon going to be releasing for public feedback, essentially crowdsourcing ideas from the public for a series of innovation competitions that we would be able to launch. And these might be things around how can you make the data that you provide to the public more digestible or more educational and help to visualize some of that information as a basic example. And the last prong of what we do is something we call Digital Reg. It's essentially an in-house think tank, if you will, where we spend a lot of time trying to educate our colleagues as to what we're seeing and learning, as well as collaborating with other domestic and international regulators around fintech engagement best practices. We recently entered into a fintech collaboration arrangement with the UK's Financial Conduct Authority and view that as a really great way to kind of learn from them what has worked well and what doesn't work well, and we'll do the same and share with them some of our experiences as we build out our efforts. But in any event, obviously we spend a lot of time as well talking about the topic of today, which is DLT and blockchain, so I'll save my ammo for that conversation. Thanks. Kelvin.
Great. Hey, everyone. My name is Kelvin Chen. I joined the Federal Reserve Board about a year and a half ago to help the bank supervision side think through technology issues. So just for context, I hadn't appreciated how manifold the Fed's mission was when I came over, right? So many of you guys are probably familiar with its monetary policy side. There's the financial stability side. There's a payment side where they run a payment system. And they do a lot of really interesting work in those various divisions as they relate to blockchain, right? So there's been talk of whether or not central banks should be issuing digital currencies and whether or not that should be on a blockchain type project. There's been talk of whether or not cryptocurrencies pose a financial stability risk. And in the payment innovation space, when people are looking for faster payment solutions, blockchain is often pointed to as a potential solution. None of that is me. What I will say is that in the banking space, what we're finding is that for all the innovation that we're seeing these days, whether it's blockchain or even something like a Venmo or a marketplace lender, all these innovations generally need to tap a bank somewhere in its banking and its technology stack in order to provide its services. Because if you're going to be in the financial sector, you're going to need a bank for things like access to traditional payment rails, like the ACH rails or Visa and MasterCard. You're going to need a bank if you want access to consumer deposits or data that's related to consumer deposits. You're going to need a bank if you're going to originate a loan. And so for a lot of blockchain companies that are focused on payments, that are focused on moving money from point A to point B, they need a bank relationship. And so when you need a bank relationship, you're now essentially in our world, right? Because we want to make sure that when our banks engage outside parties, they do so in a safe and sound way, they treat consumers fairly, and they comply with applicable laws. So as an example, if you're going to be an exchange, someone's got to be able to send money into the exchange. The exchange, in some cases, may store value in a US dollar account before they convert over into cryptocurrency. When they convert out of cryptocurrency, they may put that into an account that they hold for you, and eventually they've got to then send it to your account via some sort of payment rail. That's a bank partner. And so I help the bank regulator think through what our rules should be in that space. And I should take that a step back, because in a lot of cases it's not really a question as to what rules should apply in terms of new rules, but a lot of pre-existing rules work just fine. Right? And so I help the regulators kind of think through how those rules apply to new technologies, and then what the edge cases are that may require new changes, and we could talk about that in the future. The last thing I'd say is that I also, by training, was a consumer regulator, and so I was at the CFPB, which is the primary federal consumer regulator, and helped them think through how they should approach cryptocurrencies. And ultimately, we opted with going with a sub-regulatory approach and instead focused on a consumer advisory. So we put out an advisory in August 2014, and I kind of dusted it off for this presentation just to kind of remind myself of what it said. And it was nice. It's held up all right. And so that was an example where we looked at our toolkit and we thought through a couple of different things we could have done, and I think we made the right choice.
So at the SEC, we kind of look at innovations to financial technology and the financial industry through the lens of our mission, which is to facilitate capital formation and to protect investors in the markets. And so we've been approaching, I'll call it fintech generally, but this deals with new technologies and emerging areas like DLT, peer-to-peer lending, crowdfunding, artificial intelligence. We try to engage with the industry early on, and as with the CFTC's Fintech Lab, we have created kind of I would say a fintech facilitator, a hub, where folks can come to the SEC and ask for specific in-person meetings with our staff, and we have had literally dozens of meetings over the past year or so with industry, with practitioners, with entrepreneurs, developers coming in and talking through their ideas with us, and we give them an audience, put the right people in touch with them depending on the application of their technology, and try to just guide them through and point out various issues that we as a regulator might have concerns with. Anecdotally, we've had a lot of great interactions. We've been learning a lot on our side. We've been, I think, imparting some knowledge to the industry and hopefully giving them some comfort that the SEC will, one, listen to what they're saying, and two, try to act as a guidepost where we can. So we've set up two specific groups that deal with distributed ledger technology. The first is the Distributed Ledger Technology Working Group, of which I'm the head, and that's been around since 2013, originally as the Digital Currency Working Group, but then we've expanded as the technology has been kind of implemented beyond what I would say virtual currencies. And that's division and office-wide. So we have membership throughout the commission in our various divisions and offices of people who really study this area. And the idea of the group is to create open internal dialogue so that we're all studying a problem and foreseeing areas of examination concern, enforcement concern, or regulatory concern. We're seeing whether or not regulations are sufficient to fit what's going on, or whether they need to be revised in some way. I will say we don't regulate technology. We regulate implementations of that technology and conduct that comes within our regulatory remit. And there are various ways in which DLT specifically is touching the Commission's activities. So in the area of corporation finance, we have applicants who are filing registration statements to register new products for sale. One example of this would be, for example, the Overstock.com digital securities registration statement, which was filed and deemed effective some time ago. We have our Division of Trading and Markets that if exchanges seek to list new products, for example, exchange-traded products that use Bitcoin or Bitcoin futures or some other crypto, those entities are making applications with our Division of Trading and Markets to list those new products so long as they follow certain specifications, and those are working their way through the process. We have a division of enforcement. That's kind of where I fall in at my other hat, and we're looking at areas where we have investor concerns around either potential fraud or unlawful activity in this area. One very active area that we're looking at is the issuance of tokens or coins on a blockchain. Typically, you'll see a lot on the Ethereum blockchain issued under the ERC-20 protocol, but these are tokens or coins that are issued in some kind of crowdfunding or fundraising event in order to build an enterprise. Sometimes those tokens come with various properties. Either they entitle the holders to certain voting rights, certain dividends, certain share in the company, or some use case in a proposed system. So we're looking at those very carefully to determine whether or not that event involves the offer and sale of a security, and if so, whether there's been any violations of law in connection with that. And there are investor concerns in that area that we're really focusing on. We have a division of investment management who's looking at various applications of either funds that are set up to invest in cryptocurrency or advisors to those funds that want to advise clients based on crypto asset holdings. And so across the board, this technology is hitting the commission, and we're setting up various oversight working groups to keep us all on the same page and to liaison with our partners in law enforcement and regulatory arena, such as the CFTC. We have a close working relationship with them, and we have for some time. So we're closely coordinating with that. And then on the other side, besides the beneficial uses of DLT, as you can imagine, and it's been pointed out here, that whenever you have an emerging technology, you've got bad actors in the space that would take advantage. And so on the other side, we're closely partnering with our law enforcement partners around the world to address the various risk issues that might be posed by this new technology.
Excellent. So I guess, I have a few questions here, and then, like I said, I will open it up for the audience Q&A. So this question that I have is for Valerie. So early on today, so we had a lot of sort of interest around sort of the utility tokens, and sort of if they're issued as a security, must it always be a security? Can it be a security only during the startup phase and then no longer be a security once it becomes exchangeable for goods or services? Just again, wearing sort of not representing the agency, but on your own, I think there's a lot of confusion or sort of a lack of clarity around this particular issue, and I just, maybe if you can, share some, what your thoughts are.
Sure, yeah. So I guess our real activity in this area started with our investigation of the DAO. And the DAO was a token issuance on the Ethereum blockchain that took place in 2016, and in the course of about a month, about $150 million worth of Ether were raised in this crowdfunding event. And the idea was that the DAO, the Decentralized Autonomous Organization, DAO, that would essentially act as an organization that existed everywhere and nowhere and not really controlled by humans, but controlled by this immutable code, would exist out there on the Ethereum blockchain, and the idea was tokens would be issued, folks would purchase the tokens with Ether, those folks would then be able to vote on projects that were proposed to the DAO. Those projects would be funded. If the projects made money, the money went back to the DAO and then would be distributed to the token holders, which to a lot of people at the SEC and probably in the securities industry clearly seemed like a security to us. So we investigated that case, and in that case, the commission decided rather than punish the people who had participated in this event, to kind of publish a report of investigation. And it ticked through the various tests that the commission applies to determine whether or not something is a security. The securities laws define security, and there are certain categories of things that you and I will all recognize pretty clearly as being a security, like a stock certificate or a bond or something like that. But it also says that an investment contract is a security, and there's been decades of case law that define what an investment contract is. And essentially, an investment contract is when folks pool money into a common enterprise with the expectation of profits on their investment to be generated by the efforts of others. Now, that can be fleshed out in the case law, and there's been different scenarios, but that test has stood the test of time and has been applicable to many, many different types of situations. and new products as they come along. So I will agree that the use of blockchain to issue and distribute a digital asset is a real kind of groundbreaking thing. But in essence, in the economic reality of the transaction that's happening, if you apply the test that we've had for a long time, I think, that's the test we will apply at the SEC right now to determine whether or not something is a security. And we've done so not only in the Dow report, which I would encourage you guys to read, but since then we've filed 3 or 4 actions in federal court trying to stop what we allege are fraudulent ICOs that are happening out there. Now, this concept of a utility coin is really nothing that you would see anywhere in the securities laws. So the concept of the utility coin, I think, was probably generated in the space by people who are trying to engineer a situation that would get around the securities laws for whatever reason. And the securities laws can be daunting to some if they've not gone through it, and I think you'll find in this space there's a lot of actors who aren't used to dealing with regulators. And sure, issuing a coin with software, giving it a name, and then collecting money with no cost is an attractive proposition. But the laws that protect investors are there for a very good reason. The laws that promote good disclosure and fair disclosure of a security and its issuance and the company and the folks behind the company and what your plan is going forward and the background of the people involved and what your audited financials look like. Those are all really important pieces of information for investors to have, and kind of that's been the law for a long time. So the way the SEC is looking at it, if what's happening, if the economic reality of what's happening in an offer or sale of a token is that there's an offer or sale of a security or an interest in a company, then all the panoply of the securities laws will apply.
If I could just jump in, and we're not supposed to moon over each other's work in a public setting, but if you haven't taken a look at the Dow white paper, I do think it's really worth looking at. You have to click through the press release to the actual 20-ish page paper. One of the things that you hear about as a regulator is a lot of concern about creating norms through enforcement or gotchas and not creating an environment that's conducive to technological change. And I think it was really remarkable seeing the agency, the SEC, pull from very clear, foundational case law in security. I learned about the Howey test in second year of law school in my securities regulation class, somewhere in the first third of the semester. Right, so it's a case that goes back to 1945. It's a case that makes sense for people to use, and it's something that any securities litigator should be well familiar with. So they not only use clear precedent that's well accepted, but then also when you issued the white paper, you guys didn't sue anyone, right?
Yeah, we didn't.
And I've never seen that. I mean, that's remarkable, right? So they set out the norms, they put out a 22-page paper clearly describing the technology, clearly explaining how things would set to these facts, and then they didn't sue anyone in this case, so that everyone had fair notice, and then also had sort of a warning shot across the bow, so that when they did come back with litigation a couple months later, everyone knew the playbook. There were no surprises, and basically the SEC gave you their brief that they would be filing against you if you didn't change your pattern or practice 6 months from then. So I mean, I don't have any opinions about other government agencies, and I can't, from an official perspective, weigh in on any normative ideas as to whether or not things are good or bad, but I thought it was really remarkable what they did.
Do you think that there needs to be better guidance in some of these? When we get a lot of questions from the industry, can we do this, can we not do this? When it comes to sort of evolving technologies and the applications that they want to sort of, they've identified this particular use case, they want to do it. Some say, we need sort of a regulatory sandbox for at the federal level. I mean, there's been talk about sandboxes. Is there a need for more sort of guidance? Is the guidance what we have sufficient, or do we need in your sort of, again, not attributing to sort of your agency, but do we need sort of better guidance on sort of, say for instance, with in the Fed, more of sort of the transactions using blockchain, can we, is this permissible activity? Is this not permissible activity? How can you structure it to be permissible or not? Is there a need for more guidance or more clarity, or do you think what we have currently is sufficient?
The securities laws are very broad and principles-based, and I think if you were to start down the road of being very prescriptive and putting out specific releases about hypothetical situations, not only would you probably waste a lot of time, but you would probably create a roadmap to get around it, and at the same time encourage kind of a form over substance approach to things, and then you might actually cut off what would be a helpful technology by steering the direction of the industry in one way or the other. So what we've done instead, and I think it's been very productive, is to have, with the announcement of the DAO, we also announced our Fintech Hub, which is essentially a mailbox where people can write in, and anyone literally can ask for an audience with folks at the SEC and its various divisions and offices and sit down and talk to people about their proposed use case. And what we found is a lot of people are curious and they come in and they don't have very well-formulated ideas. So it would be very difficult for us in those situations to give someone a green light here, a green light there, when none of the specifics have been worked out. And the securities laws, even though they're broad, the conduct that we regulate has to, for example, an exchange, if you're looking at whether something acts as an exchange, there's a very specific definition. So we have to understand what your use case is and the mechanics behind it before we can tell you something about it. I mean, we can't give advice, but we can certainly guide people in the right direction. And it has been very productive. People come in and they tell us their ideas. We say, have you thought about this? Have you thought about that? And they may go back to the drawing board and look at it a different way. And we've found, I think, an increasing sophistication in the folks that are coming to us, and their ideas are more formulated. And on top of that, the SEC's always had exemptive type relief or no action type relief. So if folks get to the point where they actually have a system that they want to propose and get some kind of pronouncement about, they have a mechanism to do that already.
So Daniel, to you, maybe if you can sort of tell us more about sort of the CFTC's recent Technology Advisory Committee meeting and how the Commission thinks about DLT, blockchain, and sort of from a policy and regulatory standpoint, do you think that these sort of emerging or evolving technologies should be regulated, and if so, how so?
So, I think you've heard today about a broad spectrum of DLT-related efforts. And so at least I like to think about this on a spectrum. You have on one hand, these open public ledger systems that frequently have a virtual currency or cryptocurrency attached that serves as the economic incentive to power that network. And on the other hand, you have the private permissioned ledger systems and a lot of activity that takes place in between, some with certain attributes of each end of that spectrum. What's interesting is that all aspects of the DLT spectrum, implicates the CFTC in some way, shape, or form. When we talk about the open ledgers and cryptocurrencies like Bitcoin, folks are probably aware that there are now Bitcoin futures products, and that's something that the CFTC regulates. We also do have enforcement jurisdiction over fraud and manipulation in interstate commerce of commodity transactions. So we do think about that space through that lens, but I'm going to leave that for a minute because I think you heard a lot about it from Val as well. And the point being that there's a lot of collaboration between agencies in thinking about how you view that part of the world. When you get to the permissioned or private DLT systems, there's a lot of potential application from a capital markets infrastructure perspective. So when we start looking at that and through things like the Technology Advisory Committee, which is one of our FACA committees, it's a group that the Commission has convened that can help think about how certain emerging technologies may impact our markets. We held our first public meeting last February and started tackling some of DLT application to capital markets infrastructure. And it gets you to start thinking about things like what might future states of clearing and settlement look like when you apply DLT. And then something that's really of interest to the Commission is what might future regulatory reporting states look like. Now, again, we may be far off, and I think one of the things that's really important to note in all of these private permission DLT conversations is whether there's actually a business case for adoption. There's a lot of really good hypothetical advantages of DLT systems, efficiency, transparency, traceability, but there's also got to be the justification that kind of pushes industry to adopt, because without adoption and broad-based adoption, it kind of undermines the value of DLT. But assuming a world where DLT is providing those kinds of efficiency and cost justifications to market participants, you could imagine a world where a regulator serves as a node within the ledger system. And currently, we have a world where market participants have to essentially aggregate data and push data through a fairly manual process to the regulator. That data is received oftentimes not in a standardized format, which makes analytics quite difficult and just managing data quite difficult and costly to all sides. If you're a node, and if the regulator is actually a node and has access to real-time standardized data, and I personally think that's one of the big advantages to DLT efforts, is it forces standardization, right? Everyone has to actually adopt the same set of data formats and standards. You can imagine an instance there where the regulator has that real-time access, which can enhance surveillance possibilities, as well as reduce costs for industry that's trying to comply. So that's something that we'll explore further through the Technology Advisory Committee, but again, I think it's really helpful, at least in my worldview, to think about DLT across the spectrum and realize that it implicates different types of regulatory reactions and considerations depending on what you're talking about.
Excellent. So now we have a few minutes. I want to open it up to give the audience a chance to ask questions. We have a mic runner here. If anyone has any questions, I'm sure you all do. Yes.
I'll try to put this into a concise statement, but it's often hard. As you know, there's a lot of different variables in regulation and in this blockchain space. I guess my question comes from there is that spectrum of blockchain technology. You have your private ledgers and then you have your public ledgers and whatnot. It seems like the regulatory focus is kind of on separating that digital aspect away from the blockchain, and throughout this conference we've kind of emphasized blockchain technology without talking much about the underlying digital assets. But in my opinion anyway, those underlying digital assets do provide value in the form of economic incentives and often are really beneficial to the technology in promoting some of the best aspects of the technology, such as decentralization, immutability, and encouraging the actors in the system not to change anything in the system, being global and then being open to the public and being transparent. And I think what we will struggle with in the implementation of blockchain technology is, can we still provide that public transparency, when the government, for example, goes to implement these things, can we still keep some of that immutability and, public transparency? And can we approach regulation in a way that allows for that without kind of stifling that? So I guess my question is, how can regulators approach regulation while still providing these incentives for immutability, decentralization, and things like that blockchain offers?
Any takers?
Yeah.
So,
go ahead. You start.
So what I would say is that you covered a wide breadth of things, right, to start with, and implementations of blockchain technology are going to be very different based on specific use cases. So on the one hand, you've got fully decentralized immutable protocols, and speaking in my personal capacity, I think that it's interesting, right? I don't know if you guys have seen the Fred Ursum chart where he talks about sort of protocol development and how protocols like open internet protocols used to be done on a decentralized basis, but you kind of run out of money at some point, and so then you've got very brittle protocols, and so now we're all stuck on things like iMessage and Facebook Messenger because only giant companies can develop protocols. Whereas, to your point, creating a protocol with an underlying asset creates an incentive for people to buy in so that you could actually potentially have a fat protocol, right? Like a well-funded protocol where there's a lot of value in the protocol and you can build stuff off of that. I do think that there'll be a lot of tough investment scams that come out of that, and I see a really rocky future ahead of it. But I think that the notion of that is quite, there's a lot that's appealing about how Fred sees the world with that. That is quite different than a government implemented blockchain, right? This is something that you also referenced in your question, right? And so the regulatory approaches to either is the expectations for transparency for either, the expectation for when it's government implemented, is it really a blockchain? Because is it really decentralized? All of that changes, right? When you're talking about payments, it's a different regulatory regime than when you're talking about cows or UPC codes, right? And so, I think one of the keys that we try to focus on as regulators is to look at what's actually happening there rather than focusing on the underlying technology. One of my favorite laws is the Electronic Funds Transfer Act from 1978. It was written 40 years ago, and it still covers all kinds of new technology because it was written in a very elegant way, right, that focused on what's actually happening and what people's expectations are. And I think that one of the things that's hard for us is trying to focus on okay, is this a cow with a UPC code versus is this a potential payment mechanism where there are different laws that come into place. But it's certainly where we spend a lot of our time thinking about those issues.
Any other questions?
Yes, so I think we agree that the tokens can have utility and provide an underpinning for a lot of the value creation we're talking about today. Are there specific instances in which you've identified token utility that is not regulated as a security?
I've seen a lot, and I haven't seen a pure utility case yet. I think most of what we see, especially in the tokens that are issued on a blockchain by some central issuing set of a group of entities or people or promoter, have the hallmarks of a security. I think especially when you have immediate secondary trading, it's hard to argue that folks are buying it by the droves. Millions of tokens for utility, in many cases for a system or ecosystem that has not yet been built, as though the token has no functional utility. So I think that's the majority of things I've seen. I haven't really seen the pure utility case, but I'm just speaking for myself.
Just a quick follow-up then. Is it a concern that the example from earlier, the value cases that are going to be taken offshore and other places are going to end up with these industries of the future? Because if you treat every utility token as a security and every business case has to deal with all of the SEC and CFTC and FRB requirements, people just aren't going to do it. You can't invest that much in regulatory and transaction work to support that kind of a proposition. Is that a concern? Is anybody trying to look at an approach to legislation that would deal with that?
A couple different questions there. I think it's always a concern that we lose good technology or investments to offshore, but I think traditionally we've had very strong securities markets here because of the investor protection and market integrity rules and regulations that we have in place. So I think in the long run, while you might have folks going offshore who want to take advantage of this, especially in this hyped up market the way it is now, I think eventually the really legitimate players will want to be in markets that are strong and that are protected, and investors will want to invest in. So I think that's just been a question that's always been part of the policy around securities laws. What was your second question?
Whether there's any idea of legislation that could, help foster the industry while still protecting investors.
That's of course for Congress, but I am aware that there are some ideas being kicked around. But we'll have to see what the legislators determine is in the best interest.
And on that note, although we have a lot more that we could talk about, clearly we are running up against our time limit here, so I want to take this opportunity to thank all of our panelists for participating today. This was truly an engaging conversation. I would like to turn it over to Dan Roche. She's the Vice President for Sapient Consulting, Public Sector, to the stage. Thank you.